Hey, how's it going, guys? Welcome back to another episode of Market Insights. In this video, I will show you guys how exactly gold could potentially hit $7,000 by 2026. Also, I will touch on one extremely important bullish signal to the stock market, and as well as Tesla's recent breakout. On top of that, I will also share some of my views on why I believe the recent riots will not affect the market that much, because there are other major factors that are way much more important. Today's video is packed with a lot of actionable values, so please make sure you watch until the end and do not miss out anything. Alright, let's get started. In my last video, I mentioned that we're in this worst case scenario in the market that the financial assets are in rapid inflation where the real economy is in deflation. And I also mentioned that in such an extraordinary economic environment, the single best opportunity is in gold. If you haven't watched that video yet, I highly recommend you to watch that video first because my analysis in that video lays a lot of foundations for this video. I will put the link in the description below so that you guys can check it out. In the first part of this video, I want to present you guys a very interesting model to analyze gold price. And also I want to show you guys how this model can show us the gold could potentially hit $7,000 by 2026. This model has four phases. The first phase is from January 1996 to January 2005. Starting from the early 1996, gold crashed and went to a bear market for 5 years. It reached the bottom around the early of 2001 and started to rally back to the 1996 high. The 1996 high was a very strong resistance. Gold has tested this resistance level several times from 2004 to 2005. And finally, after January 2005, the gold officially held the breakout from the resistance, got out of the bear market, and started its bull run. In total, it took 108 months to complete the entire phase 1, and the drawdown from the resistance level to the bottom was 39.5%. Alright, after phase 1, gold entered phase 2 in February 2005 and officially started a major bull market. After 78 months, in August 2011, gold hit all-time high, $1,913, and this was the end of the phase 2. The next month, in September 2011, gold had a big crash and headed to phase 3. The entire phase 2 lasted 78 months. The total return of phase 2 was 357.6%. Next, the phase 3. Starting from the September 2011, gold entered another long bear market from 2011 all the way to the very end of 2015. It was a 4.5-year bear market for gold. It finally bottomed in December 2015 and started its rally again. The entire drawdown of this gold bear market was 41.3%. It was very close to the phase 1's drawdown. Right now, we just finished May 2020. Gold is definitely in a strong short-term bull run and on its way to retest the all-time high. From September 2011 to May 2020, in total, it is 105 months, very close to phase 1's 108 months. And the entire trajectory of these two phases are very similar to each other. We can even say that these two phases are almost identical. It appears that history is almost repeating itself again. So if we follow the same trajectory of the past, we should see that the gold will have extremely high probability to retest the all-time high in the next 3 months. Probably we'll retest it a few times, then we're gonna have a strong breakout from that resistance and then make another new high. If that happens, which I believe it will most likely do, especially in such an economic environment, then the gold will officially enter the phase 4. The phase 4 will follow the same trajectory in the phase 2 and start another major bull run. Then that bull market will take the gold to around $7,000 in 6 years. Alright, there you have it, the 4 phases model that could potentially take gold to $7,000 by 2026. Even though it's just a technical analysis modeling on the monthly price action of gold, if we analyze the fundamental economic environment, it actually supports this model and show us we're most likely in the early stage of a major gold bull market. There are 3 major drivers for gold price. First, and also the biggest one, is the monetary policy controlled by the Federal Reserve. Low interest rate and increased money supply will drive the gold price up. When the Fed chairman Jerome Powell went on TV a couple of weeks ago and tell everybody there's no limit on what Fed can do and we will never run out of money. That's his original words. On one side, That clearly shows the Fed is abusing the power of having the dollar as the world reserve currency. On the other hand, what I hear is that this is the most bullish signal for gold you could ever dream of. The second major driver is the supply and demand of physical gold. The biggest buyers of physical gold are the foreign central banks around the world. Russia and China are the two biggest buyers. The main reason they do it is to increase the credit available in their market and to stimulate their own inflationary economy. And that is what makes gold such a great and a safe hedge against inflation and a decreased currency value, because all the other central banks are using it and they cannot print it. The third driver of gold price is political and social uncertainties. If the first two drivers are based on the hard economic data, then the third driver is more on the psychological part, and it's a huge part. When there are increasing political and social uncertainties in our economy, for example this year, we have COVID-19 pandemic, global lockdown, protests and riots not only in the US but all over the world. The US and China trade war seems to escalate to a Cold War 2.0. When there are so many uncertainties arising, investors tend to be more risk averse, moving away from risky assets slowly to the safe haven like government treasuries and the golds. There's one thing I would like to highlight here is that in Japan and Europe, a negative government bond yield has already become a norm. As a result, that makes government bonds much less attractive for investors, even during such uncertain bad times. And the negative bond yield is actually good for gold. In the previous videos, I've been talking about how the bond yield could help us navigate the stock market, but it's also a good indicator for gold price. When the 2-year yield hits zero and crashes the negative rate territory, gold price will explode. So here you have it, the three major drivers of gold price. Based on what is going on in the US and as well as the rest of the world right now, all these three major drivers are pointing to the same direction. Gold will go up. I have been in the financial market for 11 years, and I've never seen such a bullish environment for gold. Buying gold is almost a no-brainer. I want to share with you guys one very simple framework that many investment banks and hedge funds are using to price in all those three major drivers in one model. Hopefully it could help you guys navigate the gold market quickly on your own. So basically the whole framework is to view gold as the indicator of the liquidity levels in the financial market. Let me explain. On the entire spectrum of market liquidity levels, in the middle part, we have balanced liquidity. This is the time we call everything is normal and the economy is in a stable growth period. Currencies are stable and the credit growth is in control. On the left side of the spectrum, we have insolvency liquidity, which means there are no buyers. There is no enough liquidity in the market, businesses are in debt crisis or even default, and the asset prices are crashing. Recessions or even Great Depressions normally happened in this part of the spectrum. On the right side of the spectrum, we have excessive liquidity, which means there's too much money supply in the market and the currency value is dropping. Hyperinflation is one extreme example in this part. Alright, so the gold will normally underperform in the middle part when the economy is normal and stable, and the gold will do extremely well on the two sides of this liquidity spectrum. In the last video, I mentioned a couple of signals that are showing bullish signs for the stock market. Here, I would like to add one more bullish signal on top of that, which is the corporate bond yield spread is going down, and that is good for stock market. If you are new to finance, a corporate bond yield spread means the difference between a corporate bond yield and a government bond yield. So why is this so important? Because the credit market is an extremely important and also sensitive signal showing how much tolerance the investors would like to have on taking risk. The corporate bond market is considered a risky market where the government bond is considered a safe haven, because the possibility of the government going default and not paying back your money is way much less than a company going default. But why do investors still buy corporate bonds? It's because of the high yield. Corporate bonds generally pay much higher interest than the government bonds, so the investors can generate much higher returns, especially in a good economy. So in a normal time, the spread between the corporate bond yield and the government bond yield should be stable. But when the market crashes, investors tend to take less risk. So they will sell their corporate bonds and buy more government bonds as they believe there's too much risk in the market. In results, the corporate bond yield goes up and the government bond yield goes down. So the spread between these two becomes bigger or wider. On the other hand, When the investors believe things will get better soon and it's safe to take more risk now, they will start buying more risky corporate bonds for the high yield and the high returns. It results, the corporate bond yield will start going down, and that will make the difference between the corporate bond yield and the government bond yield smaller. That's exactly what we're seeing right now. The spread is going down, or the spread is tightening. And that is definitely a bullish signal for the stock market. One more thing to add on this corporate bond market is that the Fed has printed more than $3 trillion this year to save the market. But they didn't buy any stocks. The market they truly wanted to save in order to stimulate the investors' confidence is the corporate bond market. So the majority of those helicopter money actually went to buy all the low-graded corporate bonds, so that the Fed can control the yield spread, make the spread go down, and indirectly save the stock market. That shows how important and sensitive the corporate bond yield spread is to the general market, especially the stock market. Recently, a lot of people have concerns about the riots. My opinion on this issue is pretty simple. Violence and the riots are horrible things that could happen to our society. But as an investor, I do not think it will affect the market that much. In fact, the most important thing that drives the stock market confidence, and also where the most institutional investors focus on, is not these riots, but the re-election in November. The current administration will do whatever they can to keep adding pressures on the Federal Reserve to stimulate the market. They desperately need a good-looking market on their resume for their re-election. So there's no limit to what they can do, and buying the corporate bond market is just the beginning. Alright, before we go, I just want to make a quick update on Tesla. Definitely a good week for Tesla investors so far. Tesla has officially broken out from this long and choppy inverted head and shoulders pattern. The breakout is very clean, very strong, and also a lot of good news on Elon Musk's side as well. So Tesla looks very bullish from technical analysis perspective right now. If this breakout can hold for the rest of the June, then we can probably see Tesla hit the 1500 for the remaining of the year. I'm switching my views on Tesla from neutral to bullish right now after this breakout. I will definitely make more videos on Tesla and to share some of my views on that. Let me know what you guys think. If you guys have any thoughts, please leave them in the comment section. I would love to read them. Alright, that will be the end of this video. If you are new to this channel, my name is Vic. I make videos every week to share some of my thoughts on what is going on in the financial market, and also what are the trade ideas or investment opportunities that you should pay attention to in the market. If you are interested in the world of finance and the business and find my videos have been valuable to you, please consider subscribing. Thanks so much for watching guys, and I will see you guys soon.